Good morning, everyone. Welcome to our discussion about liquidity risk in investment banking. Today, we will talk about what liquidity risk is, why it matters, and how we can manage it to keep our financial institutions stable and strong. Liquidity risk is a major concern for investment banks. It happens when there are mismatches in the maturities of assets and liabilities. In simple words, liquidity risk means a bank might not be able to pay its bills on time without suffering big losses. This can happen for several reasons, such as market volatility or credit downgrades, which make liquidity problem worse. Asset liquidity. This risk involves the difficulty a bank may have in selling its assets quickly for a fair price. When the market is stressed, demand for certain assets can drop. This situation can leave a bank unable to sell its holdings without taking large losses. For example, if a bank has many illiquid securities, it may find it hard to find buyers during a market downturn. This would affect its cash flow and overall financial health. Funding liquidity risk is when a bank cannot access funding to meet its obligations. This can occur if the bank's creditworthiness is questioned or if market conditions worsen, making it hard to raise money or secure loans. A sudden drop in deposits or a loss of investor confidence can lead to a liquidity crunch. In this case, the bank might have to sell assets at low prices or turn to emergency funding sources. Market conditions significantly affect liquidity risk. In a volatile market, uncertainty can increase. This makes it harder for banks to predict cash flows and manage their liquidity effectively. During times of high volatility, the difference between buying and selling prices for assets may widen, making it even tougher for banks to sell assets quickly at fair prices.
Good morning, everyone. This is my topic at identifying potential liquidity risk. What is liquidity risk? So,
I'll
liquidity
be the
risk
next
refers to
reporter
a
for
risk
the
that a financial
contingency planning.
institution may not have
Leading
enough
to the
cash or
liquidity crisis.
liquid
The
asset
first
to
one is
meet
the
short-term
liquidity
obligations.
crisis happen when a company
So,
doesn't have
we conduct
any
regular
cash to
scenario
pay bills,
analysis. This
and a good
analysis
plan helps the
helps
company to
identify
act
vulnerabilities.
quickly and
Example
avoid
include
bigger
sudden
problems.
deposit
So for the second
withdrawals,
one is
market crashes, and
escalation
counterparty
process. So
defaults.
if
So,
a company faces many
sudden
trouble, there
withdrawal.
should be a
So,
clear
ano
process
ini ang
followed.
scenario
It
where a
means
large number of
deciding who
clients
should be handled issue
unexpectedly
first,
withdraw their
who should be
deposits. So,
informed,
this
and
is leading to a
with
liquidity
what
crunch.
action to
Then,
take.
next
Well
is
plan
market crash.
process and
So,
avoid
this is a
confusion and speed
situation
up
where
decision
asset
making.
values drop sharply,
For the
reducing the
third one is
firm's ability to sell asset
emergency.
quickly for
Second one,
cash.
emergency
Then
funding.
next
So
is
a company
Next na
should always
rest na
have
liquidity
backup
is
plans
ang
for getting extra
counterparty
money.
default.
Have
So, kung ang major
backup
financial
plans for
partners
getting
lisod
extra
na
money
fails
when
man na
this could
mamit ang ila
form a bank
obligation, it's
loans and
potentially
invest
causing ripple
or
effects
other
and liquidity
resources. So
management.
having these
Risk mitigation
options
strategy.
re-
So, this
can
is to
already
prevent
help
or
the
minimize
company to
liquidity
stay
risk. Then, so
stable
financial institution
during
implement proactive
a
in
financial crisis.
strategies
And for the third one is
including
communication. When a
diversify
crisis
funding. So,
happens, and clear and
diversify
fast
funding
communication
is
is important kasi and
ibali
company must
zay
make
mo
sure that
magkalailahi
mga
na sources
um,
ng fund dili
employees
rakon
and managers and stakeholders
nagdepende ikaw sa isa ka sources
mahibay sila
thousand
kung ano yung
ibali zay
nahitabo
imong
and what steps are
deposit
being taken.
underbank
Regular
lending
update,
and
mga
bond
regular
issuance para
updates na
zay
mag-help
imo
to
ma
keeps
duyuran in case
and
na za
focus.
rest na moabot sa cash flow. Then next is liquid assets. So, maintaining liquid assets, keeping a buffer of highly liquid assets, house on cash, government bonds that can be quickly accessed in times of need. Then next is collateral management. So, robust collateral management ensuring sufficient high quality collateral is available to secure borrowing when liquidity is tight. So by conducting regular stress tests and implementing these risk mitigation strategies, financial institutions can strengthen their resilience against liquidity shocks and ensure financial stability. That's all po.
I'll be the next reporter for the emergency planning. Reading to the liquidity crisis. So first one is liquidity crisis happen when a company doesn't have any cash to pay its bills, and a good plan helps the company to act quickly and avoid bigger problems. So for the second one is escalation process. So if a company faces many trouble, there should be a clear process follow. It means deciding who should be handled issue first, who should be informed, and with what action to take, a well-planned process, and avoid confusion and speed up decision making. For the third one is second one, emergency funding. So a company should always have backup plans for getting extra money, have backup plans for getting extra money when this could form a bank loans and invest or other resources. So having these options, um, re- we can already help the company to stay stable during a financial crisis. And for the third one is communication. When a crisis happens, and clear and fast communication is important kasi kaya company must make sure na ang mga employees and managers and stakeholders mahibay sila kung ano yung nahitabo and what steps are being taken. Regular updates na mag-help to keeps everyone calm and focused. So for the next slide, internal transparency and awareness. So, ang isang company mag-work sa better kung ang mga employees understand its plans and know their rules. So, a strong communication plan make sure na an important information is shared with everyone. So, for the community clearly, and companies need nila to explain their plans and the risk, to know how the company is handling problems and what is expected from them. So, unclear communication helps avoid confusion and misunderstanding. And for the next is employee training. So, employees must must be trained on how to deal with financial risk and crisis. They should know what action to take if a problem happen. So training helps employees stay prepared and act quickly when needed. So for reporting naman, an employee should feel comfortable reporting or financial risk or mga issues na naila manotice, because there should be an easy way for them to share concerns without fear. So keeping an open channel for reporting helps the company para to fix problems before they get worse. That's all. Communication plan. So, internal transparency and awareness. So, ang isang company mag-work sa better kung ang mga employees understand its plans and know their rules. So, a strong communication plan make sure na an important information employees must be trained on how to deal with financial risk and crisis. They should know what action to take if a problem happen. So training helps employees stay prepared and act quickly when needed.
Monitoring and review adapting to change. Continuously monitoring liquidity positions, review the risk management plan regularly. Update the plan based on market changes, stress test assumption periodically. Here are the 3-step cycle. The first cycle is monitor position. Continuously track financial or operational position to understand current status and identify any potential risks or changes. The second cycle is review regularly. Frequently assess risk management plans and business strategies to ensure they align with the latest conditions. And the last cycle is update plan. Modify and adjust plans as needed based on new market trend, risks, or opportunities. The process ensures that businesses stay proactive and responsive to changes environment, reducing potential risk and improving decision making.
Key takeaways: a robust risk management framework. Proactive liquidity risk management is crucial. Scenario analysis and stress testing are essential tools. Clear communication and regular review are vital. Managing financial risk effectively is essential for maintaining stability in any organization. Here's a simplified explanation of the key components. First is proactive management. It is crucial for stability. This involves predicting potential challenges and taking steps to prevent them before they occur. Second is scenario analysis. It is essential tools for assessing risk. This is a strategic planning technique that involves exploring multiple possible future outcomes and scenarios. It helps organizations assess the potential impact of various uncertainties and identify appropriate courses of action to address them. Third is communication. It is vital for success. Sharing information openly within the organization ensures that everyone understands potential challenges and the plans to address them. Clear communication fosters collaboration and effective problem solving. By implementing these practices, organizations can better navigate uncertainties and maintain stability.